All right, welcome aboard. This is Reed Nicholson's channel. What's the name of your channel?
Reed Nicholson.
Reed Nicholson. So creative. My goodness.
Yeah.
My name is Justin Rutkowski. I'm the host of the Out of the Rut podcast. I'm also a mortgage lender partnering with Reed on this video. And I wanted to bring you guys in today, number one, just to do a, we're going to cover some basics on some things that first-time home buyers need to know and need to expect. So, Reed, welcome aboard. Introduce yourself.
Thank you. Yeah, my name is Reed Nicholson, as Justin said. Also known as Reed, your realtor, and I am basically a licensed real estate agent in the West Michigan area. Have been for about a year and a half, and I believe today we're going to be talking about first-time home buyer expectations in this current market.
Yes, absolutely. And if you've paid any attention to the housing market lately, it is tough. There's no doubt about it. And what it meant to be a first-time home buyer 4 years ago is very different than what it is today. So to start off, Reed, give me a couple tips when you're meeting with maybe a young couple or a single person who's brand new to the real estate market and you're starting from scratch. What are some tips that you're going to give them off the bat to make sure that they're not running around all over the city putting in offers willy-nilly? What are some strategies that you've found that have worked to help your buyers get some offers under contract?
Yeah, for sure. Usually when I meet with a client for the first time, especially if it's a first-time buyer or even a buyer in general, I always like to at least give a quick rundown of exactly what to expect, especially with the market the way it is right now. Most buyers get into it thinking one thing and it ends up being a completely different thing. So right off the bat, I always like to give good expectations. What do those look like? Expect to have a lot of competition. There's a ton of other buyers out there and there is no supply of homes. So expect there to be other people bidding on the house. Expect yourself to have to pay over asking to get an offer accepted. And if that's not something you're comfortable with, well, then this probably isn't the time for you to buy a home. But that's just one thing. Expect the competition. Expect to overpay, I guess you could say. But expect to spend money if you're going to buy a house in this current market.
Let me stop you there real quick, because one of the things that I always like to talk about, and I've had a handful of clients over the years that have looked at buying a home as an expense. It's a line item in the budget, and your home, for 99% of people out there, your home will be the largest purchase of your life. It'll be the largest financial transaction you will ever take part in. With the exceptions to that would be maybe business owners, maybe if you're an attorney and you're part of closing deals on a regular basis, that could be an exception. But for 99% of Americans, buying a home is going to be your largest financial transaction. It's also it's not like buying a car where you're going to go spend $20,000 on a car that as soon as you drive off the lot, it loses 20% of its value. Your home, you can consider that to be an asset where over the course of time, you're investing in something. You're investing in something that's going to appreciate or gain value over time. So sometimes the sticker shock is real when you go and you show a $200,000 house and your client gets all excited. They write what they think is we're gonna go 202 on this house.
Good luck. And
this house sells for 240, and their hair's blown back. Like somebody just paid $40,000 more than what this house was being listed at.
Yeah.
How do you approach some of those situations when you've got new buyers that are getting in the market? They maybe wrote their first couple offers, and they just get smoked. Like, how do you kind of explain what's going on to them?
Yeah, well, and I guess just to piggyback off of what you were saying about it being an investment, that's the number one thing I tell people. If you're getting into this market for a 3 to 5 year home, you got the wrong idea. You're not looking at it right. If that is the case, I'd say probably better to either go rent or buy a place and rent out with friends or something. But either way, if you're going to be looking at buying a house, especially nowadays with price points being the way they are, one, it is an investment. So when I look at a house, I don't look at the price tag. I look at what's it going to gain me 10 years from now. And that is my biggest recommendation. If you're going to buy a house that you can actually see yourself living in for at least 10 years if you have to. I'm not saying you have to live in it for 10 years, but if the market, let's say, like right now, the big talk is the market's going to pop. Okay. Maybe it does, maybe it doesn't, who knows. But if it does, you're going to want to be in a home where you can see yourself living there for another 10 years and just ride out the market, because everything's cyclical and it will go up and down, and you will appreciate in money if you can live in it for another 10 years. If you buy something and you only live in it for another 3 years, well, that might be where the investment comes into not coming into play the way you wanted it to, or it puts you underwater in a spot where, again, you just don't want to be. So for me, my biggest piece of advice, especially right now and with all the uncertainty going on in the world, buy something where you can see yourself living in there for 10 years, whether it happens or not. That's no big deal, but see yourself being able to live there for at least 10 years.
Yeah. By the way, and just to kind of piggyback off of what you said earlier, talking about markets being cyclical, do you know that 3 out of the last 4 recessions did not affect the housing market?
Yeah, I did actually know that.
Yeah. So that's a common misconception, because people are so hyper fixated on 2008. In my professional opinion, again, I don't have a crystal ball. I'm not giving you specific financial advice to your situation, but in my opinion, we won't see another 2008, just because most people want to look at 2008 as being an economic problem when it was actually a criminal problem. And the things that banks and lenders were doing, bad lending practices in the early 2000s led to an inflated housing market that sent several banks underwater. People lost faith in that. And
why not expand on that a little bit, though? Because I feel like just giving more context on
what
happened in the 07 to 09 era is gonna
absolutely. And I'll try to break it down in a way that's easy to understand, not only for the listeners but for myself, because as much as I know about it, it's so intertwined and interconnected. There's so many different factors and what caused it. But back in we'll talk about the criminal side first, and then we'll talk about some of just like the happenstance of where our country was demographically as a whole, and some of the demographic factors that led into that. But back in the early 2000s, there were lending practices that were subprime, and basically, what a subprime loan is something that does not meet the conforming requirements of what we would consider a conforming mortgage today. A conforming mortgage today is a loan that's backed by a private entity, Fannie Mae and Freddie Mac. Those are the two big ones. Or Ginnie Mae, which is it's a government entity that backs the government loans that are written. So that would be an FHA loan, a VA loan, or a USDA loan, or rural development type loan. Yeah. So you've got your private, your conforming sector mortgages with Freddie and Fannie, and then you've got your government in those two buckets. So that's as we know it today. Those are what we would consider conforming mortgages to be, or conforming loans. Non-conforming loans, or subprime loans, were loans that were given out willy-nilly, and they didn't really have guidelines. It's similar to when you go and you get an auto loan today, where you walk into the dealership and you walk in, they pull your credit, and they ask you how much income you make, and whatever income you tell them, that's what they put on the application. And if your debt-to-income ratios are somewhat in line, you've got yourself a car loan with nothing down, and the only thing that is collateralized is that vehicle. Yep. Does that make sense?
I just bought a car.
Yep.
Super easy.
Yeah, it's super easy. It's almost like you don't realize what you're getting into, because you just walk in, you're signing papers, and you don't even have to write a check for anything. Yeah. There's not I was
kind of shocked.
No skin in the game.
Yeah.
So there were real estate loans that were taking place back in the early 2000s that were causing this to happen. So now that's on the front end, but what most people don't realize is what happens on the back end of a loan after after it gets transferred. So imagine, let's say I own a bank, and you come to me and you say, Justin, the Bank of Justin, I want a house for $100,000 and I want a $100,000 loan. Okay. So if I have $100,000 on deposit, I'm gonna loan you $100,000 for that loan to pay the person that you're buying the house from. You have a house, that person gets their cash because I gave the seller the cash, so that the borrower is going to make payments to me every month as the Bank of Justin. Yep. But what happens is I lend out that $100,000. Now I don't have $100,000. Okay. So what these banks are doing, me as the Bank of Justin, I need to get that money back quickly so I can turn to person B and give them another $100,000 loan. So what I'm going to do with that debt is I'm going to take that debt and sell it on the secondary market, and so that I make a little bit of money on that sale. The person A is going to now make their payments to whoever's servicing the loan, whoever holds that debt now. And now I have $102,000 or however much the price was to sell that loan. And the servicer is going to collect the payments, and they're going to be the one that profits from making all of the interest.
So what's the point of, if they're going to sell a loan for like $2,000 more than what they gave it out for, where's the advantage of the person that they're transferring the loan, or the bank that they're transferring the loan? Where's the advantage there?
To the person who's servicing the loan, they're now the ones that collect the interest on the loan every month.
Gotcha.
So it's kind of a win-win for both sides.
Really, 15 years from now is actually
correct. So in the long run, that person is going to be, they're going to make more money on that one deal in the long run because they're collecting interest payments month in and month out. I just made that one-time purchase so I could get that money back, so I could go out and lend it to person B and wash, rinse, and repeat. And $100,000 in this world is an incredibly small amount of money. I'm just talking about it in context to make the example kind of simple. Now, here's where it gets complicated. When you've got hundreds of millions of dollars of these loans that are being sold off to these sold in the secondary market, when all of those loans start going bad, and these people stop making their payments,
they go bad.
That's what happens. So there were banks that were holding onto these loans that they purchased off the secondary market. Okay. And when these loans started failing, I have to explain this part too. The Federal Reserve or the federal government has regulations on these banks. If you ever go to a bank, your local bank, if you don't see a little sign on the teller window that says FDIC on it, that bank is out of compliance, and then they could be sued for hundreds of millions of dollars. So all banks that I'm aware of are backed by the Federal Deposit Insurance Company, which is a private company, by the way, which is hilarious.
Seriously.
Just like the Federal Reserve is a privately owned company too. But we're not going to get into that. Yeah, we're not going to get that deep into it. Go down the rabbit hole with that. Yeah. So banks are required to hold, if they hold debt on their books, they're also required to hold a certain amount of cash on their books as well. Okay. So I'm sure. I don't know off the top of my head what the ratio is, but I'm starting to get out over my skis here on this because this is kind of the limit of my knowledge. But basically, so long story short, some of these banks were going underwater. Like you could be underwater on your home if you owe more on it than it's worth. There are these banks that had more outstanding debt than they had cash on their books. And that's what sent. I believe the first one to topple was a bank in Illinois that went under. Okay. And when that happened, that kind of triggered a tidal wave of these transactions that were happening behind the scenes. Yeah. So that's why when that bank failed, it kind of was like
Tipping point.
the tipping point or the dog whistle to what was actually going on behind the curtain, and everybody discovered that these loans were failing, and so that caused everybody to tighten up their lending practice. So these loans aren't being done anymore. This money that people are using to buy these houses is much less available.
Yeah.
And then combined with the fact that so people can't buy new houses. So if your house can't be purchased, that's going to cause the value to go down.
Right.
So it was this whole tidal wave that sent everything into a tizzy, and houses lost 40, 50, 60% of their value in a very short amount of time, which then in turn tanked the stock market. People lost, money in 401ks and pensions and stuff like that. So long story short, because we have tightened up our lending practices as an industry, we're not going to see that kind of recession happen again like we had in 2008.
And so basically, in a nutshell, you're saying banks sold or gave out more loans than they really could afford to do, just
Correct.
willy-nilly.
Because they knew that they would be able to sell them on the secondary market.
Right.
Once the secondary market said, "Hey, we're not buying these crap loans anymore,"
people started missing payments.
Correct.
Loans started to fail or go out, which caused the debt.
Correct. You had janitors making $12 an hour that were getting stated income loans to buy these houses at 9-10%, and they would make one payment and then they would stop making payments.
Gotcha.
And I haven't even gotten into some of the types of loans that were being given out back then that no longer exist today. Loans with like giant, like a 5-year term with a giant balloon payment at the end.
Yeah.
The idea was, we'll get you a super low interest rate for this 5-year term, but at year 5, you either have to pay up in full,
Fat check,
or you're going to have to refinance and do a different product. And some of these balloon loans started coming due, and these people, they couldn't refinance because these lending guidelines had been tighter. The houses weren't worth what they owed on them because the housing market had tanked. So it was just Murphy's Law. Like, if it could have happened, it did happen.
Yeah.
And if you... The Big Short is a good movie. Like, if you want to watch, like, you would call it historical fiction, is a good way to put it. They make some good points and they spell it out in a way, and they probably make some of these analogies a little bit better than I am. But long story short, more than likely, if a lot of people are
what we're seeing today.
Correct. The recession that we're seeing, that we're potentially going to be in at the end of the year, is due to inflation, and not necessarily due to the housing market. So inflation also means that house prices are going to keep going up.
Right.
So let me ask you this: when you're first meeting with a first-time home buyer, you're talking about what they're looking for a property, and what are some questions that you're asking people? Let's say I'm your first time home buyer. What are some questions that you're going to ask me, as far as like what am I looking for a home? What area I'm going to be in? Like, what are some of the things that you find are the most important?
Yeah. For me, I want to know everything. I want to know everything about the client. I want to know what your goals are, what your life plan is, where you see yourself in 10 years. And then I want to know just more about like what you like to do lifestyle wise, and just really get a good feel for how you live your life and what kind of interests you have. Because at the end of the day, if I know all of that information about you, I know how I can kind of best help you or better help you find the right home that's going to kind of fit all those things. So some questions I always like to write off all the bat is just literally personal questions. I don't even like to get into housing off the beginning. I just like to ask, what's your family look like? If you have kids, husband, wife, whatever, dogs, do you have any pets? I always like to ask that. And then I kind of like to go into, what do you do for fun? What kind of activities do you do? What kind of lifestyle do you like to live? Just different things like that to get a better feel for, at least get a better feel for who you are and the lifestyle that you live. And then from there, then we can start talking a little bit more about housing. What areas were you thinking about? Based off how you answered the first questions, I can also give suggestions on areas and price points and different areas that might fit, that I think might fit better based off of what you were saying about yourself. But yeah, I mean, from there, it's basically now we're gonna just talk together, and we're gonna figure out areas. We're gonna figure out price points, kind of the whole 9 yards, and basically go from there. If you have questions about areas, that's another thing. I do live in the West Michigan area, so I have a pretty good knowledge base on the whereabouts, so I can kind of go deeper into that as well, and hopefully by just diving in personally wise and what your goals are, and what you want your future to look like, ideally that's going to give me the best advantage I can have at actually helping you find what you're looking for. So.
Absolutely. Well, let's move on to the offer process. So let's say, Reed and I, we partner up with quite a few clients now. And so you have somebody that we've worked with together. I have them pre-approved. I've done a pre-underwrite on them. I've reviewed their income, their assets, their liability, and their credit report. I've put together a preliminary file. And now you and your clients are out shopping. Let's say you've got a client named Joe. So Joe's out shopping, and he finds 123 Main Street, listed for $250,000. It's a beautiful 3-bed, 2-bath, 1,500 square foot house in a nice part of town. What is going to be your strategy for writing a competitive offer? And what are some tools that you're going to utilize to make your offer stand out in a stack of maybe 10?
Okay. Yeah, I mean, I guess just to get right into it, there's a few main ways that you can really put some oomph to your offer or make it a little bit more appealing than other people's. The very best way that you can do that is by giving an appraisal gap guarantee. If you don't know what that is, basically what it states is you're going to put an offer in, and let's just, for easiness sake, say you're going to give them a $10,000 appraisal gap guarantee with your offer for the home. Well, let's say it's listed at $200,000. You're going to give them an offer at $200,000 with a $10,000 appraisal gap guarantee. If you do that, what you're saying is you are willing, if whatever the appraisal comes back at, so let's just say the appraisal comes back at $200,000, you're guaranteeing that you're going to bring another $10,000 to the seller cash out of pocket, because if the appraiser appraises the home at $200,000, well, that's all the bank's going to give you a loan for. So whatever extra money that you state there, that's what you have to bring up on your own. This is by far the number one way to do it. It gives sellers peace of mind, because now they know, okay, whatever the appraisal comes back at, whatever my house is worth to the bank, which pretty much determines worth of any price point in any market, I'm still going to get X amount of cash over that. That's the appraisal gap. That's the number one thing I recommend. Next best is going to be an escalation clause. Again, these are great, but basically, again, you have a $200,000 house and you're saying, well, I'm pre-qualified all the way up to $250,000. Okay, great. What we can do is we can put in an escalation clause saying you are willing to beat out the next highest bona fide offer by, let's just say, $2,000 up to $250,000. So basically what you're saying is you'll beat out whatever the next highest offer is by $2,000 all the way up to your max purchasing power of $250,000. That's another kind of slick way to get in and actually get ahead of other people that may be bidding higher than you. And it also kind of can keep price points lower on the other end of the spectrum if there's not that many offers that you're competing with. Well, at least this gives you $2,000 above whatever that highest one is. So it's another just great way to ideally get that offer accepted. And then let's see.
Before you go any further, I'm going to cut you off here. I wanted to circle back to the appraisal gap.
Yeah.
So the appraisal gap, if you're listening to this and you're not working with Reed or I, this is just general information for you. Always check with your lender. Realtors especially need to hear this. Always check with your lender before writing an appraisal gap into your offer, because when you're going above and beyond and potentially paying more for what the house appraises for, the lender needs to know that to run that into their equation, because your realtor might think that you can qualify for that, but your lender might say otherwise. So that's why communication is key in these situations. Realtors especially, hey, we're going aggressive on this one. We're going to write an appraisal gap. Hey, outstanding. But make sure that that's communicated to the lender so you don't get in a pinch where you may have gotten out over your skis and maybe written an offer that's beyond your scope.
Yeah, and that's why, again, it kind of goes back to in the very beginning, asking those personal questions. Like for me, being a realtor, I ask those questions. How much money do you have saved up? How much money are you looking to spend? What's your purchasing price you ideally want it to be at? Obviously, Justin's going to help out with a lot of that on that end. But one of my first questions I want to ask people is, how much money do you have saved up? Because if you have no money saved up, it's going to be a lot harder for you to buy a house. If you have 10 grand saved up, it makes it a little bit easier. So those are, again, just if you can do your due diligence in the very beginning and ask those questions, again, that also will give you more knowledge on the back end when you actually are writing offers. And then, yeah, like Justin said, always checking and touching base with your lender is going to be the next biggest step on that as well.
Cool. All right, you were about to start talking about a third thing before I cut you off.
Third one, down payments. The bigger your down payment, the better. Cash is king in the real estate world. So, I don't think you're going to have a seller that's going to complain about a bigger down payment. That's really only going to increase the strength of your offer. So that'd be my next one. The bigger the down payment you can go, the more attractive your offer is going to be.
Absolutely. And if you're in a position where you're going conventional, you have good credit, and you're putting 20% down, we're seeing a lot of appraisal waivers these days on about 40% of properties, at least in the West Michigan area. An appraisal waiver is awesome because it saves you $500. You don't need an appraisal, and the loan will close in 10 to 15 days instead of 25 to 30 days. So,
which that's amazing too. You brought up my next point: waiving inspections, waiving the appraisal if you have the option to. Let's see. And working with the seller on possession dates. These are kind of extra things that you can do. But one, being a realtor, I highly recommend you don't waive inspections. But if you really have a home that you really want, and that's what it's really probably going to come down to, then yes, that is an option. And it's one way to get your offer through. The other one is waiving the appraisal. If the seller knows that he doesn't have to worry about an appraiser saying his property's worth less than what you got an offer accepted for, gives them even more peace of mind, which is making your offer even more appealing. So again, waiving appraisals, not something that I'd recommend, but if that's what you got to do to get the deal done, go ahead and do it. And what was that last one?
I don't know.
Oh, working with, and then you can also, this is just something that I always do just to, one, talk with the agent a little bit more on the listing side, but as well as when I'm working with my buyers, I always ask the listing agent what his sellers are looking or wanting for possession time after close. Is there any possession time they want after close? Is, what do they want? Because then ideally, and with that information, I can write it into the offer as long as it's okay with my clients, that they give them whatever that possession time may be. That way I can write that into the offer and make it quick and easy, and that way they can see that we're working with them a little bit. Those are going to be your 5 big ones. I would say to really putting some extra power in your offer. I can't really think of any.
I think that's good. So let me ask you this: okay, so let's say you've gone through all the legwork, you've written a strong offer gets accepted. What happens then?
Offer gets accepted. Well, it kind of depends. Did you waive inspections or did you not? If you didn't, we got to get inspections ordered within 10 days. Most of the time, your realtor, well, actually, if you're working with a realtor, he should be doing that for you. So really, you don't have to worry about that. All you got to do is pay the check for the inspector. Typically, that's $350 to $500. Then after the inspection comes through, as long as everything's been good there, there's no structural issues or anything like that, you both agree to how the report came back as, great. Now you got the appraisal. Appraisal is usually going to take anywhere from about 2 to 4 weeks to get out to the home. Usually 3 weeks is kind of the sweet spot. That is, again, another expense usually towards the buyer in this market. But basically, that one's going to run you anywhere from about $400 to $600, I would say. And once the appraisal comes back, depending on where it is, if it's low, well, now you got a whole another rabbit hole you're going down.
Yep.
But if it comes in at asking price, perfect, move forward to closing. If it comes in over asking price, perfect, move forward to closing. Seller, sorry, the buyers have no obligation to tell you what that appraisal came back at. So as long as it came back at asking or above, we're good and we can move to closing.
Mm-hmm. Yeah, absolutely. So a lot of buyers will ask the question of, and I've heard some sellers ask this too, is like, hey, if our listing was 300 and that was agreed upon purchase price and the appraisal comes in at 310, what happens? And the answer is the purchase price stays as is. It's the $300,000 purchase price.
Yep.
So,
and with that, again, the buyer, you as the buyer have absolutely no obligation at all to tell the seller what the appraisal came back at. If it came back
Correct.
good, that's all you have to say. It came back good.
Mm-hmm.
So there's that piece too.
Yep, absolutely. And you paid for the appraisal. It's your appraisal. So
exactly.
Cool. All right, and that's a wrap for us, ladies and gentlemen. Thank you for tuning in. This is Justin Rutkowski with Nest Mortgage, NMLS 1489431. Also host of the Out of the Rep podcast. Maybe we'll simulcast this. Maybe we'll put this up on my channel too.
Yeah, you should.
Yeah, I should. We are signing off on behalf of myself, Reed Nicholson, a.k.a. Reed Your Realtor. We want to say thank you for tuning in. Have a great rest of your day.
Peace.